Hey everyone, I want to welcome you to this special edition of the HXPodcast. Today we're going to do something a little bit different. We're going to sort of do what I'll call a version of a special report. The stock market so far in 2024 has been a very good place to invest. We've been in a nice bull market, but for the most part, it's been pretty quiet. There's not been a lot of action, especially in the last few months. Volatility's been at all-time lows, and all these other things. And all that changed in the last week. It's gotten a lot more interesting. So what we wanted to do is we actually invited our good friend Mark, who's joined us before, who is a regular investor, just like you, our viewership. And we're going to just talk a little bit about the markets, talk about our favorite idea and all that. So let's start with Mark. How you doing? How's your summer going?
It's going great. I'm in beautiful Southern California right now. The weather's beautiful.
Nice. Well, you do the thing that a lot of the Arizonans I know do is you're in Arizona for the winter, but then you head down to like San Diego, Coronado kind of area for the summer.
Yeah, they call us zonies here.
Yeah, no, I've heard that a few times in San Diego. So,
Yeah.
Cool. Well, so, Mark, let's start. Like, what's sort of your, as what I would call sort of a regular investor as opposed to a professional investor. And just so you guys know, I'm going to move to a screen share here with a couple things. What are your thoughts? What's your big questions with the market right now?
Obviously the presidential election is, going to have an impact, but it's been going up pretty steadily, other than really just recently. But it's been a relatively good year in the stock market.
Got it. And then, so I think what you and I were talking about was just talking a little bit about what just happened, and maybe I'll walk through that, because we've seen some pretty big moves in the last week or so. Does that make sense?
Yeah.
Yeah. So look, I mean, I think I've got here a chart of the S&P 500. And you said it exactly right. And this is just sort of talking about what we were talking about in the beginning here. This has been, since that October bottom, this has been a straight shot up. The other thing about it too, I mean, we have had really extended periods where we don't even touch the 50-day moving average. I mean, this is actually kind of a crazy, and interject, Mark, here if I use terms or something that you want clarification. Once we got above this 50-day moving average, I'll sort of say the rising 50-day moving average on December 1st, we literally have spent a total of about 6 weeks below or around the moving average, and the rest of the time we've been well above it. So this is about as strong as a market can get. Now, though, I'm going to say that there were a couple things that we got worried about this week. So, we do our free daily. You and I were talking about this earlier. This is our page, daily.hx research. On Monday, we published this note, which said, take your profits. And basically what we were doing is back in March, on March 21st, actually March 21st was literally right there. This is the day when we published the note. We had said, look, the market's had a good run. It's sort of overextended. It just feels long in the tooth. And we made a call that we were going to see a correction. And you can see here, and this is going to be relevant in a second, that we corrected then it was really not until May 14th. So almost 2 months later that you hit another high. And we were beginning to feel the same way. Our note literally came out. Actually, I hate to say it, our note literally came out right here on the 15th. And what we were saying in particular, why we thought that there was a potential for a pullback, a couple things. The first is, this is, here we show, this is where we had made the call on March 21st. You can see what the market did. We talk about the RSI, the relative strength index, as a measure of overbought. The RSI on the S&P 500 had gotten over 81. So for an individual stock, that's pretty rare. For the index, it's extremely rare. Going back to 1985, there are only a dozen times that it's gotten that overbought. And you can see here, if you go through, and this is the way to think of 10-day, 15-day, 20-day. This is actually 2-week, 3-week, 4-week, right? Because we're talking about trading days. So there's 5 days in a trading week. Once you got there, if you actually looked out 3 weeks ahead of time above that 81 RSI, you only had a winning percentage 17% of the time. Now, keep in mind that in rolling 3-week periods throughout the history of the stock market, you've got about a 55% winning percentage. So these odds here basically said, this is the equivalent in blackjack of, you're sitting on a 6 against a dealer 10 or something like, just a really, really bad hand. So we were basically saying it's time to at least, and not go short, but to at least take profits. And that's exactly what we asked people to do here in HX Trader. We also went from, back here we had about 14 positions. This is our trading publication. By the time we got to the end of the day, Monday, we literally had 4 positions in the book because we were taking profits and also sometimes just realizing some losses. If we had things that we had losses and had owned for a while, I didn't want to own them into a bad tape. Does all that kind of make sense to you?
Yeah, I'm more of a long-term investor because of taxes and that type of thing. So I pay less attention to what you're talking about, which is really, I think, positions that you had on that were trades for
Right,
relatively
tactical positions.
Yeah. So I'm more comfortable this long-term and I don't do much trading. So I did see your note and you called it right on, but for me, I'd rather, take a paper, not a paper loss, but see my paper go down a little bit. My statement go down a little bit, avoid the taxes because I believe in what I'm holding and I'll just hold it for the long term.
Well, let's talk about that because like I said, this market went from not saying a whole bunch to saying a lot. And when I say that, we had a low volatility market. There weren't a lot of signals coming. We actually got some incredible signals that happened beginning last Thursday. So I don't know if you remember last Thursday, the inflation report came out. I think, obviously with all of the Trump Biden stuff, there's just been a real change in sentiment. We can talk about what that means too. But what happened was the winners, which had been the biggest stocks in the market, we had a day where all of the winners got hit badly, but all of the losers, like this is all the Russell stocks that have been struggling. And by the way, the stock market wasn't doing poorly. If you took out the Mag 7, the rest 493 was actually up about 6% on an equal weighted basis year to date. That's not bad, right? The normal, good years up 12%. So what we saw is a really, really rare indicator called a 770 thrust indicator in the S&P 500. Now, okay, I know I'm going to say things like 770 thrust indicator. It sounds like bullshit. It sounds like, some voodoo or something like that. But these can be very powerful. What this one is it says that for 3 days in a row, more than 70% of the names in the S&P 500, so 350 or more, went up, okay? That again, we were talking about people being very concerned about a narrow market, being just a few stocks driving the market. Now what this is saying is the vast majority of the stocks are going up. So this is pretty rare. Since 1950, okay, so it's going back 75 years, this has happened only about 50 times. And this is the table here is really small. I'm going to see if I can we don't really need to see the table. But you can see here's the 50 times that it happened. Let's see, there we go. My browser's catching up. Here's the 50 times that it has happened. But what's incredible about the 770 thrust indicator is that in the short term, okay, the very short term here is 5 days, 10 days, 21 days. And these are the hit rates, 63, 74, 70%. Those are pretty good hit rates. But in the long, that means positive, that the market was higher after getting this 770 thrust. But when you get out to 6 months in a year, it's 87% and 95.6% of the time. So in the short term, it has decent hit rates, 60, 70%. But in the long term, in the intermediate term, 6 to 12 months, these are incredible hit rates. 87% of the time, and 6 months later, the stock market is higher. An incredible 95.6% of the time, the stock market is higher in a year. So I just want this to soak in. We've got a 75-year data set. We've got 50 data points. And 96% of the time, the stock market is higher. I'm going to show you one more thing, too.
Excuse me, sorry to interrupt. Why would that be? What's the rationale behind why that might be?
So I think what it is when you look at a lot of these indicators, they're basically like we can never really know the true balance of buyers and sellers in the market through any sort of analysis of like a survey or anything like that. But the volume and the number of advancers versus decliners and things like this are showing us the strength of the waves and the tides underneath. So I like to use the ocean example, right? What's happening on the top of the market any given day, those are the waves, right? But underneath the waves, there's the tides, and the tides are much more powerful than what's happening on the surface of the ocean. So what this is showing us the tides. If you are in a stock market that you can actually see 3 days in a row of the S&P 500 having 70% or more of the names up, then it's telling you that the core underlying buying in that stock market is so strong that it's likely to persist. Now, okay, here's the thing. Could Russia send a nuke, or, could something just completely exogenous happen? I mean, yeah, I'm not going to discount that. But what's amazing is in the 75-year history of this is actually pretty crazy. The 2 times this didn't work, one of them was in 2011, and the market was only down 2.4% a year later. The other one was in 2007, and the market was down 9.6%. And that's probably a little bit of a better cautious. But, when I'm dealing with, and I think it was 47 or 48 data points, and I've got 2 that don't come out, this is the kind of data that we want to hang our hat on. So although we've been cautious, we came out very cautious on Monday. We think it's highly likely that the market churns. With a 6-month to 12-month view, we're very bullish. Let me just give you one other piece here.
Ask, one quick question.
Ask away.
In the 80s, I remember late 80s, there was Elliott wave theory. Does this have anything to do with that?
This doesn't. Elliott wave theory is another way of looking at technical, and people still use Elliott wave theory all the time. Elliott wave theory is more about looking at the movement of individual prices in sort of these standard waves of like understanding where the average owner sits. So when we talk about the 50, 100 day and 200 day moving averages, the reason those have value is the 50-day moving average, by its definition, is where most of the people who bought the stock in the last 50 days own the stock. So that will have an import, because if the stock gets to that level, you've got a lot of people, 50 days worth, that own it at that average price. So it's going to have like some reaction. Elliott wave theory is more like that. This is more of what you would call a volume confirmation signal. So and let's go, because the very next day we got another one of these, and this is from Twitter. Both these were from a guy named Grant Hawkridge, who's at All Star Charts. This is called a Whaley breadth thrust indicator. Okay, I know these sound crazy. I know it sounds really esoteric, but they're very, very powerful. This one is when the number of 5-day advancing stocks, this is stocks that are up 5 days in a row, exceeds the number of 5-day declining stocks by a ratio of 3 to 1. Okay, it's another way of just saying a lot of stocks were up a whole bunch of days in a row. Look at the data here. Okay, this one goes back to 1962. This one's only been hit about 15 times. This is actually more rare. Look at the 126 day and 252 day. Those are 6-month and 12-month. We've got a 93% hit rate on the 126 day and a 100% hit rate on the 252 day.
That's crazy.
So again, I want to go. Yeah. So yeah, it is, right. Like, and so there's a thing that, like, when we get really rare data, I actually respect it. And again, I want to use this example of the tides. The ocean, what just happened to the stock market here. Let's go here. The ocean is this. These are the waves on the ocean. The stock market just sold off, whatever it was, 2%. What do we get here? Let's go look. I'm looking at the S&P did today. This is. I'm going to go on this quickly because this is most of the HX portfolio, and we don't want to give it away. It was down 0.78%. But the whatchamacallit, the waves are down, but the tides underneath this market are very strong. So, going to what you're saying is, as a long-term investor, and then I want to come back a little bit short-term, and then we'll go into like Talon, for instance, what's going on there. As a long-term investor, I'm actually more bullish today than I probably, and we got a bunch of these thrust signals back here also, very similar, but ones that weren't even as powerful as this. So with inflation cooling, with employment cooling, with the political situation, and we can dive into that, I'm going to actually say potentially cooling a little bit, believe it or not. I know that sounds like a strange thing. With rate cuts, being much more likely, and these thrust signals, as tactically bearish as I am in the near term, I'm as bullish as I've been all year. And look, the average return a year later, I think this was the one last thing that I just want to throw up here. When we go through the 770 thrust, you can see it here. I know it's hard to read. The average return, the median return a year later, 19.4%. Okay, so that would be up 20% from here. So do you have any questions about that? And then I want to talk one more short-term thing, and then we can jump into Talon.
It might be interesting to see what sectors went up the most, if there was any statistics that showed like this group or that group. I know they all generally went up. That's just an incredible percentage. But was there one group that consistently went up?
Let's come back to that in a second, because I think you bring up I'm going to bring up an interesting but related point. But let's talk about the correction, because I think there's actually a really interesting opportunity here. So, but I'm going to go back to those sectors and what do I think will work here? And we're going to talk about two things when we do that. But one last thing about the tactical. So a lot of people, you're less concerned about it, but a lot of people are like, well, what happens next? Well, we have a little bit of history just even this year. We've had two big gap down sell-offs in the S&P 500. Look here. On February 13th, we gapped down big, okay? I think that was actually a CPI number. Look what happened. The market bounced back, went down a little bit, and then it just continued going right on up, okay? But then we saw another gap down. This was on April 2nd. This is right after we got bearish last time. This time, the market churned in a broad range, and then we treaded water, and this is like NVIDIA got cut by 20, 30%. So if you ask me what happens, in 6 to 12 months, I think we're higher. If you ask me what happens in 6 to 8 weeks, which is relevant for a lot of different trading styles, I'd actually say it's 50-50 is kind of where I come out. And the 50-50 is that we could be in this February scenario, although now we're in the second day and it didn't act like it, or I think more likely we're in this kind of scenario where there's something to be said. There's a symmetry in the markets that when you go through a very long period of an up move, when a correction eventually hits, they're not going to be a day or two. They're going to be, a third of the length of the extension move. And the reason is it's like built up potential. So I think at this point, we're 50-50 about what's going to happen next, whether it's just going to go back up or we're going to go through this correction. We've started buying stocks. I know that you saw in our trader publication, we actually did a special report 3:00 yesterday. And then let me show you this here too. I'm going to show you a spreadsheet that we published earlier today, and I have the nice formatted version that I lost with some computer problems. But so you ask what's going to work next? Well, I'm going to say three groups of things to think about. The first is we just saw a historic sell-off in the winners versus the losers. We wrote about this today in HX Daily. And when I say historic, the numbers are crazy. Watch this. The title was a 1 in 500 million event. And what was that event? That event was last Thursday. The Russell 2000, this is it right here. This is from Charlie Bolello, who's a great person to follow on Twitter. The Russell 2000 small cap went up by, I forget what the number was up on that day. It was up by like 4%. And the S&P 500, which is large cap, was down by 50 basis points. That's a 4.5% one-day move. That's the difference between one-day small caps and large caps. That is a 6 standard deviation event. 6 standard deviations, and I think I wrote about it in the report, is 0.00000097, or it's something crazy here. I forget the number. The point is, it's a 1 in 500 million event, okay? So I'm going to tell you 2 things to think about what to do next. The first is that kind of move in the Russell 2000, smaller stocks, when it happens, historically, it has legs. So another thing, so this is the Russell 2000, right? We actually saw a 10% 5-day move. That actually is also a 5 standard deviation event, like super, super rare. When that happens, this tends to have legs.
What's the average or top market cap of the Russell 2000 stocks? I know they're small, but what does that mean, small this day?
Yeah, it depends. I mean, sometimes Super Microcomputer was in there and all of a sudden got to a $60 billion market cap. I wrote about this the other day, but I don't remember the answer because it was a couple months ago. Average market cap of Russell 2000. But I want to say it's like about 2 billion. So the weighted average market cap is 2.76 billion, and the median is 950 million. Okay, so compare that to the S&P 500. And I'm going to make an interesting point here. The S&P 500 is the average market cap is the median's 30. Let's see here. I'll find it. The average market cap 65. So 65 versus 2. Okay. So, I'll say a couple things. In general, I don't really give a shit about the Russell 2000. The Russell 2000 by itself, the entire market cap is less than the market cap of either Microsoft or Apple. And the Russell 2000, I'll give you a couple other things you might not know. Half the companies in the Russell 2000 don't make money, okay? By definition, they are smaller publicly traded companies that have lesser scale, more debt, less access to capital. So, you're really only talking about 6% of the market cap of the entire stock market. And you're talking about companies, I'm not going to say that are losers, but they're obviously not in as good a position as the bigger companies. So the Russell 2000, to me, if it's doing poorly, that's not necessarily a bad sign. But if the Russell 2000 is doing well, that's a very good sign. And so the reason why, the S&P 500 has been, let's just pull up I'm going to pull up actually the equal. So here's the S&P 500, the market cap weighted version. Which are a lot of Microsoft, Nvidia, et cetera. I mean, that's just a rocket ship. Look at that thing. That's just incredible. Okay. Here is the equal weighted version. Okay, so that's the market cap. Here's the equal weighted version of the S&P 500. Okay, not up as much, but still a really nice chart. Okay, that's a nice chart. And then let's look at the Russell 2000. Okay, that is not nearly as good a chart. I mean, we are still well below the 2021 high. But what's happening is there's a regime change happening. These stocks are very subject to interest rates. They're smaller companies, they're more levered, they're less profitable, they have less cash. And what we've seen now is interest rates now finally begin to move, potentially lower or certainly stabilize, with the CPI number. And so what killed the Russell 2000 was not that rates were at 5%. It's that rates went from 0 to 5. Now, by the way, let's go back here. Let's actually go to right here. This is August 17th of 2023. Interest rates have been flat to down for a year, and they're about to go down again with the Fed cutting rates. I don't think interest rates are going to, up 1% or 2%, but stability is really good for the Russell 2000. So the first thing I'm going to say about what will perform well, I actually think you can begin to hunt in the Russell 2000 in a way that you haven't been able to hunt for a good long time. I think that there's going to be a lot more upside in the when you look at this chart. But let's go to the second thing, and I think you're going to like this one, Mark, because I got a strategy that I think is really interesting right now. What I did here is I actually took so we've seen a historic rally in the Russell 2000. We also saw a pretty big sell-off on the winners, and this is going to bring us to Talon in a second, because it was Talon that made me think of this. This group of stocks here is actually all of the first half winners of the stock market, okay? So what you have here, Vistra, which is a competitor to Talon, still to date, it's up 100% year to date. Oh. You can see NVIDIA up 145. But I want you to see here, you have these stocks here, these top, top 6 stocks, okay? These top 6 stocks that are still up on average, sorry, that was a sum. Let's do an average here. 66% year to date still. But in the last 2 weeks, I did the same thing. They are down 23%. So I think there's 2 things you should be looking at. You should begin to look at smaller stocks. You want great companies, but before you found a great small cap, you kind of maybe wanted to ignore it. Now I don't think it's the case, and we're going to come to Talon again, which isn't really a small cap. But now I also think there's an opportunity that all of these stocks, it's an opportunity to get into all these names that people missed. And so let's talk, because this will go into Talon. Let's talk about Vistra, okay? Vistra is a direct competitor to Talon. They are the second largest nuke company. This stock was a monster year to date. The stock came in at $38 and was 110 at the end of May. So that's up 250%. I think it was even outperforming Talon, it was pretty close. So what happened here is everyone was like, oh, I missed this. I can't buy it. And I was like, no, look, the stock can go up a lot more because earnings can go up because of the power crisis, all these other things. Up here with an RSI, remember, we look at this short-term stuff, with an RSI of like 80, it's like, don't do anything. But now that the stock has gotten crushed, the stock is down 30% in 2 weeks, no one wants to touch this stock because here they go, oh, I missed it. But when the stock actually comes into them, now they go, oh my God, it's an ugly chart. So my point is one good place to look of what to buy is go through these stocks that were the market winners. You can see NVIDIA, CrowdStrike there. This is actually a really great time to enter into the market winners. I don't think they're going to outperform by as much as they did in the first half because the Russell will do better. But I think many of these stocks will continue to be the leaders in the market in the next 6 to 12 months. So that's a pretty opportunity-rich environment, if you ask me.
Yeah, it looks that way. I'm still more value-focused and less technical. Just that's my bent. Yep. But I understand what you're saying.
Well, let's talk about that too. Let's go look at something like Vistra. Vistra is a great example. Again, and then we'll talk about Talon. Let's talk about value. This stock trades at 12 times earnings per share. Okay, that is not an expensive stock. No. This company also got a 1% dividend yield. Let's go here. What they've been doing, they're in a very similar situation to Talon. That they're going to see a big increase in their earnings. Here we're having some technical difficulties. There we go. This is their financial statements. What they've been doing is they've been taking all the cash flow they're making from all this the benefits in the power prices, and they've been buying back stock like crazy. So if you go down here to the shares outstanding, let's go here. They've taken, in the last few years, they went from 427 shares to 350 million shares. If we look at this on the quarters, so again, I want to address your value question here. They basically have gone. This is the last 8 quarters, or 10 quarters. 472 to 350. They bought back 120 million. They bought back 25% of the shares in this time. So and lastly, this is a company, and this is, by the way, what Talon's going to do. This is a company, we look at earnings revisions, right? So you want to look at earnings growth, which we'll look at in a second, but you also want to look at earnings revisions, like are numbers getting better or worse? Take a look at the earnings revisions for Vistra. Straight up to the right. A year ago, okay, let's go 18 months ago, people thought they were going to earn 250. Now they think they're going to earn 560. Okay, so you've got positive earnings revisions. You've got them buying back a ton of stock. You got 12 times EPS. You've got growth here, 34%, 11%. This is when power prices were down, and now you have a beautiful, beautiful entry point on Vistra. So let's go. You had some questions on Talon. You want to talk about that?
Yeah. I think Talon is, like you were saying, is sort of done the same. They had like $1 billion buyback recently, and I think
Yep.
they've used most of it. They did a private offering for like 600 million of it,
A tender offer.
tender offer,
Correct.
and then that all got taken at 113, and then I think they bought more right after that too, like maybe
at 116. Yeah.
Yeah.
So Talon's in a great position. So I'm going to explain something here. Vistra and Talon are kind of the same stock. The only difference is that Vistra is much more liquid, 26 billion, and Vistra didn't go bankrupt, so there's a lot more information out there. Remember when I was looking at earnings estimates for Vistra? Yeah. There are no earnings estimates for Talon. This is part of the advantage why we wanted to own Talon and why I like Talon more and I like Vistra, although I think Vistra is awesome as well.
What's the PE ratio for Talon?
So you need to look with Talon, because of the bankruptcy, you need to look at the EV to EBITDA. So, okay, it's just about the same multiple as Vistra, okay? But I would rather own Talon. And now, do you know why I would rather own Talon than I'd rather own Vistra? Although I think Vistra is incredible buy right here. Do you know why I'd rather own Talon than Vistra?
No. Why?
Because Vistra is likely to buy Talon. So the big difference is Constellation, which is the big guy, has a market cap of 60 billion. By the way, this one's gotten crushed the same way, as these other ones. I mean, that's an incredible move for a stock like this. In fact, when we go through that, you remember that spreadsheet that I showed you? Constellation is the fourth one here. It's down 20% with an RSI of 32. Constellation's got a market cap of 60 billion. Vistra's got a market cap of 27 billion. NRG, which was also on that page, has a market cap of 15 billion. Meanwhile, our favorite here, Talon, has a market cap of only 7 billion. So this is what the argument I was making the other day. They could pay a 50% premium or even 100% premium for Talon on today's numbers, and it likely would be accretive because Vistra, we showed trade at eight times EBITDA. Look where Constellation trades. Constellation trades at 15 times EBITDA. So they could pay with stock, they could pay double the Talon price, and it would still be accretive.
Yeah.
For on an EV to EBITDA and probably on a price to earnings. This trades at 22 times. So Talon is the one to own.
Going back to what you're saying, Constellation. I mean, that would be really accretive for Constellation to buy Talon.
Massively accretive. Yeah, exactly. But this is why. So when we buy Talon, I'm basically so what's happened with Talon now, okay? When we were buying Talon at 60, or when I recommended it at 60 right here. This is what I recommended the stock first, okay, 65, and was just banging the table. We had in front of us the simplification. We had the potential buybacks, the uplisting. We had all of these things in front of us. Those are now the stocks at 120. It doubled since we recommended it first, okay? But what you have in front of you now is just as powerful, believe it or not, is you have the earnings estimates going up because power prices are going up. You're going to have continued buybacks. They're going to do what Vistra has been doing, is just buying back as many shares as they can. And you're long this buyout option, which honestly I think happens in the next 6 to 12 months. And Constellation makes a ton of sense. But there's one thing too, and I'm just going to share this. So why do these stocks look like this? Like, what the hell is happening here with Vistra? Look at the stock, okay? So, people, there's this, I'm sure you're familiar with it, Burton Malkiel's, the efficient market hypothesis, that at all times the stocks price in everything. So I don't know how you explain to me that the stock was worth 106 on May 31st and is worth 76 today. It's just fucking ridiculous. But when I talk about stocks and price movements, I sometimes talk about what I call the crowded raft theory, okay? And this is what it is. Imagine you're on a raft. We're whitewater rafting, and we're going down a river, and there's 30 of us on it. It's one of those big ones. There's 30 of us on the raft. And because of we're both Arizonans, so because of the Grand Canyon or whatever, one half of the raft is sunny, and one half of the raft is shady and wet. And so as we're moving down the river, people just keep on getting really cold and they move to one side of the raft. And the river's still moving forward, the raft is still going, but as people move from one side, the shady side, to the sunny side, all of a sudden the raft loses its stability. So when people were equal on both sides, hit a little rock or a rapid, it didn't do very much in the beginning. You get further down the river, it doesn't take very much, and the raft goes like this, and then what happens? People go running back to the other side of the raft. That's what stock prices in the stock market do, is when you get momentum, here, everyone was on one side of the raft. That's the only place they wanted to be. And then I'm going to pull up the Russell 2000, that point right there. This was that point in the Russell 2000. Everyone in the Russell 2000 was just like, I don't care. It's too shady. It's too wet on this side of the raft. I'm going to go buy NVIDIA. I'm going to go buy Vistra. I'm going to go buy this. But eventually these things correct. And I'm going to tell you something, and this goes for Vistra. It goes for, probably goes for every stock on that list that I sent. And we published that list on both StockTwits and Twitter. This raft ain't sinking. This raft's still going down the river. This raft is still going to be a fun ride when all is said and done. And you're getting a great entry point. So I think that, I guess the takeaways here are as follows, and this is kind of to appeal to all audiences. We had a very big call on Monday saying we thought a correction was coming. We think that correction is here. I'm 50-50 on whether that correction is a very quick correction or a 6 to 8 week one. If it's 6 to 8 weeks, it could be 5 to 10%. I think that once we get past that, though, into year end, and after the summer, we can talk politics a little bit too, but after we get past this correction into year end and 6 months and a year from now, we're much higher. And I also think you're getting a chance right now to buy some of the best stocks in the market at just really great prices. And, the way I would do it, if someone wants to do it, when we talk about buy low, sell high, you sell high so you can buy low. That's actually the point. That's why we sold our trading book down, was so that we could be buyers now. I would go in and just say every week for the next 8 weeks, if I've got X to deploy, an extra $10,000, I'm just going to buy, $1,500 a week for the next 8 weeks as sort of my dollar cost averaging. And that way you're certain to catch it. So, look, we're cautious, but we think the market's serving us up some of the best opportunities that we've seen probably in the last 3 or 4 months.
Nice.
Cool. Do you want to talk politics real quick, and we'll maybe close on that, and with how that's impacting the markets?
Sure.
Well, so, the funny thing is, my view is that who's the president doesn't actually impact the stock market that much, and neither does who is who controls Congress. And I mean, if you go back through, the idea would be that the Democrats would be worse for the market, but historically they've actually outperformed, so I think it's more noise than anything else. What I do think is happening, though, is you are seeing a couple sectors, so we won't get into whether Trump will win or not, but I think we all have to admit Trump looks to be in a much better position to win today than he did 4 weeks ago. Like, I mean, again, whatever your politics are, everyone's going to agree on that. So what's been rallying with that? First off, a more business-friendly climate that also is maybe more biased against the largest companies and the largest multinationals, which if you listen to JD Vance, should be better. The Russell 2000 is much more domestic, okay? There's more likelihood of interest rate cuts here. Domestic companies, the Russell 2000 should do better. So the Russell's been doing better. Another one, and I did not see this coming. I mean, this is kind of crazy, but he is an opportunist. Trump has become crypto Trump. Okay, he's gone out there and he's a huge fan of crypto. JD Vance is even a bigger fan of crypto. All the cryptos, this chart right here, this looked like death. Look at that. Like that's like, like that chart's going down. Look what it's done here. Now, maybe this is a lower high, but I think that crypto can do very well. The other thing that you're seeing is a lot of other good core groups. We had a trade out there in the home builders. Look at what Lennar did. Now, part of this is because of that CPI print. But Lennar, I mean, we bought it right here. I mean, it just went ballistic. Look at what the healthcare companies are doing. And then I'll give you one last thing to think about. Look at Cigna here. We almost put a buy on it right here. The last thing is, I will say this, and this will be a very, very material positive. The M&A situation is going to get much better under Trump. Although Vance and Trump continue to talk very anti-big business, the fact is Lena Khan and the FTC, and they've even talked maybe about keeping Lena Khan. I'll be surprised though, but they're against like any transaction whatsoever. That will change. So, there's things like, what was the, I'm trying to remember the vacuum cleaner company that Amazon was going to buy that got shot down, all these different, Canva, which was going to be bought by Adobe, things like that. I think a lot of those transactions will be better. So net, I think it's better. And I'll say one last thing, just kind of, if we get visibility that it's decided, that's good for the markets. Like just knowing what it's going to be is going to be positive for the markets. But I kind of don't care, because I'll just finish with this. Inflation's going down. Rates are going down. The economy's good. The underlying tides of the stock market are super powerful in a way that we very, very rarely see. And so, we remain very bullish. We think there's great entry points right now, but you need to be careful because things could be tricky, in the very near term. So, cool. Mark, any other questions for us before we call it a day?
Let's check back on this statistics in a year and see how it actually did against the historical.
Sounds good. So great. I want to thank everyone for joining the HX podcast today. It's a pleasure to have you, and we will see you next week.
Thank you.